Section 3 in Chapter 10 is what banking services do financial institutions provide? So banking today is what we'll be looking at. We're going to skip this. Measuring the money supply. Now, all the money supply that is available in the U.S. is called money supply. And it's broken down into basically two different categories. There's M1 and then there's M2. Now, everything that is in M1 is considered liquidity, which means that it can be directly used right away or directly converted into cash. So what we mean by that is if you have cash in your pocket, it's considered liquid, meaning that you can use it right away. If you have a checking account, that is considered to be liquid as well, because you can use the money right away that you have. So when they're categorizing this, M1 is considered to be easily and immediately to pay for goods and services. So whatever that would look like for M1 for cash is really the biggest thing that we think of when we think of M1. Now M2 is everything, if we had two circles and M1 was a smaller circle, M2 would include all of M1 into M2 circle. So it includes all of it. Plus, it includes the things that are on the screen here. Things that such as a savings account, a money market mutual fund, both of those would be considered that. Usually when you buy things, you really don't have the option to use your savings account with your checking card or anything like that. So that's usually called that. Anything you have in investments, if you have stocks or bonds, mutual funds, those are all considered M2 because you can't just use a stock to pay for a good or service. And then a mutual fund as well. We'll get back to that one in a different chapter. But here's a definition we have here from this. So M1 is liquid, meaning it can be used right away. M2 includes all of M1 plus the M2 items in it. Now, what are some of the functions that a financial institution offers to its customers? Well, most places offer a savings account and checking account. If you haven't opened that up by this time, you really should. Junior, senior level especially. You need to start managing some money, especially when you start working this summer or have some part-time work. You should really get a savings account, and if not, a checking account as well. Checking account means that money that's in your checking account, you can use with your debit card right away, or you can withdraw money from it at any time. Savings account is you don't have a checking card for a savings account, but you can just use it for an emergency account. Money market account. Interest is not fixed, write a limited number of checks. What this means is that this is really designed to be an emergency account. Now the interest changes from day to day, it just depends what the rates are for that time, but it's a good place just to keep extra money that you need just in case of emergency, but you don't want to have in your checking account every single day. And usually they do limit on how many transactions can go in or out or transfer out of that account. And the whole idea is that you just hold on to it just for emergencies. And then we have a CD. Now a CD, certificate of deposit, is pretty easy to understand. So if you go to the bank and say you want to open up a CD, they would sit down with you, a banker would sit down with you, and you guys would choose a fixed rate, and then you would decide on how long you want to keep that money, how long you would like to keep that money into that CD, and then the bank always has a penalty. So the idea of putting money into a CD, you have a fixed rate. So let's say you decide with the banker that the rates today are 5%, over the next 24 months, and you deposit $1,000. Now, over the next 24 months, it will continue to build interest each day that goes by. Now, the bank puts a penalty out there because if you withdraw it early, then they add a fee on top of it. The idea is that you don't touch it. And the reason they don't want you to touch it is so they can lend it out to other people. So that's what a CD would be. Other offers would be loans. Now, every bank uses the fractional reserve banking system. And what that means, they are only required to keep a certain percent or a fraction of all of its customers' money on hand. So this kind of idea came from before there were banks using the Goldsmith system. And you'd go to the goldsmith, they usually had the most money in town, also they were most secure, and in return, they would give you a paper receipt. Now, then what the goldsmith would do with that is he would then lend the money out to people that were in need of loans. Now, the same thing happens with banks today. If all of us went into the same bank and we withdraw our money, they'd probably all have it for us at this time. But let's say if all of Minneapolis wanted their money out of a Wells Fargo bank, they would not have enough money on hand. Usually, the bank or the government sets a certain percent of how much money they should have on hand at every single time. Maybe it's a little more during the Christmas time because people are taking money out for gifts, but maybe it's a little less during January. But fractional reserve just means that the amount of funds they must have on hand at all times. A default. This is never something that you want to do with a loan. Failing to pay back a loan. So you go in for a car loan and all of a sudden you don't have the money to pay for it. After so many payments, your loan has fallen into default. And this goes permanently on your credit score, and it marks you as if you are not trustworthy in order to get a loan anymore. So that's what default means. A mortgage, this is what people pay on their houses. Usually you can get a 15, 25, a 30-year loan. Most people get a 30-year loan, but if you find yourself where you have a choice between a 15 and a 30, always go with the 15-year loan because you're going to pay less interest on it. So when people say I have to pay my mortgage, it just means that they're making payments on their house. That's all it means. Other services that we would find credit cards. And depending on who you ask, some people say credit cards are terrible and they should never be used, which is correct to a point, but others say that you should start using them young to build your credit. And it just kind of depends usually on your parents' conviction on what you think you should do there. So credit cards, the whole idea is that you can use it and then at the next month you get a bill in the mail with the amount of how much you owe. Now, you don't have to pay any interest on a credit card if you pay it off right away. So let's say you make a purchase of $200 and you have an 18% interest rate. Well, if you pay it off in full in the next month, you did not pay any interest on it. But the fact is, most people don't pay their credit card off from month to month. Some other simple terms you need to know. There's interest. This means, let's say you got a $5,000 loan and the interest rate was 10% over so many years. You would pay towards your loan, but then the way the bank makes its money is that, let's say that your payment is $200. Maybe the bank would keep $50 of it for interest and then $150 would go towards the amount that you borrowed. The amount that you borrowed is called principal. So you go in for a $5,000 car loan, that is your principal balance that you're borrowing. The interest is taken out of each payment. Now there's something called SI, which is simple interest, paid only on principal, and then compound interest, paid on both principal and accumulated interest. Once we get into the investment chapter, we'll talk a little bit about these terms. But the whole idea is that simple interest, there's a certain amount of interest that you'll pay in full. Compound interest, it means it builds on itself each and every month that the amount is not paid off. So how do banks make their profit? How do they make their money? How is it they always seem to have money on hand? Well, the way they do it is by interest on loans. When you go into the bank, that's usually one of the things the teller will ask you, do you want to talk to a banker today? And the reason behind that is they want you to open up some sort of line of credit or a loan. And this is how it works. So let's say this 4%, you go in with $1,000 and that you want to put it into, let's say that you want to put it into a CD, a certificate of deposit. When you lock in at 2 years at 4%, so you're guaranteed to get that 4% interest. Now we think on our side we're getting a pretty good deal. But if, let's say, on the same day that you open up a credit card and it has 24% interest, well, that means every time you don't pay off your credit card in the next month, 24% of interest is going to be added on to your credit card. So how do they make their money? Well, if you have that certificate of deposit, you're getting that 4%, but then if you're not paying off your credit card, that's 20% going back to the bank. So that's why they'll usually say, okay, 0% interest for the next 6 months. And then after that, well, then they hope that you'll hang on to the credit card and the interest rate goes to 16, 20%, 30%. The whole idea is that they try to draw you in with an incentive to open up the card, and then hopefully you won't pay off the money when it comes. So that's how banks can make decent money when it comes to this. Couple more slides here, 2 more slides. We also have another financial institution. It's called a commercial bank. This is where most of us probably bank. Wells Fargo, Bank of America, TCF. These are commercial banks. Savings and loans, building interest, making loans. We kind of talked about this in section 2, so I'm not going to elaborate too much on that one. Savings banks, these are just directly for that reason. For savings bank, so let's say we open up our own savings bank, everyone put their money into there, and then we could borrow money off each other, or also we could bring customers in who would need loans, and then the money that they would take from our accounts, we would then get a percentage of that interest back on the loan. Credit union is a co-op, which we looked at in another chapter, and kind of the same idea of the savings banks, but by doing it this way, all the members pool in their money. So let's say we have 5 members and we all pool in $2,000. Let's say there's 6 members, $2,000. So that's $12,000 available. And let's say one of us wants to open up or needs to buy a car for $10,000. Well, instead of me having to go to the commercial bank, I can go to my co-op credit union, and then I could borrow the money from that, and then I would get an extremely low interest rate because we are a co-op trying to benefit its members. And then in return, I can get my car, pay less interest, and then everyone gets a little piece of the money I borrowed from them in return as well. So it really helps its members. And then a finance company, this is major purchases. This would be mortgages, maybe it'd be open up a line of credit. It'd be business loans, finance companies. So when you open up a mortgage, usually there's a mortgage lender you would talk to, which is a finance company. Last slide. Other types of banking: electronic banking, ATMs, debit cards, home banking. As most people probably do, Saturday mornings is usually the day where people seem to do their banking because all of the bank websites seem to be going slow. It is so nice today that we don't have to write checks anymore as much as we used to because everything can be done automatically. You can automatically have your mortgage payment come out, your credit card payments, your utility bill. You can have your tithe. Certain churches have where it automatically withdraws your tithe. So, you don't have to do anything. You just got to manage the account, but just it does it for you. Automated clearinghouses, bill pay, same thing. And then smart cards, gift cards, campus cards, store credit cards. This is all electronic things. If you've been watching any commercials about banking, you will find that people don't have to swipe their card anymore. They can just tap it, or they can just use their phone in order to pay for items as well. So that's kind of the direction we're going into. A lot of I just saw recently, PayPal has this massive campaign about old cash and new cash, new ways of paying for things versus old ways. That you can use PayPal now to buy things, and you don't have to use cash anymore. So the whole idea is that we'll get to a cashless society one day. Will we ever get there? I don't know. it's definitely moving in that direction. But that's just some of the things that electronic banking offers. All right, that is the end of section 3. If there's any questions, please let me know.